Hello, and welcome to another video. Today, we're going to learn some things on investing. And this is a Charles Schwab magazine that I have right in front of you. The most recent version of it. Let's take a look. There are some advertisements here, but together with that, you will see some interesting articles and hear interesting advice. There is a CEO's note. Living up to your trust. And they have ETFs, and this is the name of a bond, two bonds, and a long-term treasury ETF. Not a great, actually that is a good operating expense. Right here, 0.05. This is how much they take to manage the fund. The bottom line, the new contribution limits for tax advantaged and tax deferred savings plan, and why you should take full advantage of them. So, the limit for 2020 is here, $19,500 for 401k, 403b or similar. And if you are over 50, you can also do a catch-up, which is another 6,500. So that results in a total of 27,000 actually. No, 26. My math. Then FSA, the max is 2,750. HSA for a family, $7,100. And HSA for an individual is $3,550. And they say why you should max out. These are two hypothetical investors who started contributing to their 401ks in 2000 and maxed out their accounts in the first year. In the following years, investor 1 never increased his annual contribution, while investor 2 maxed out her account every year, taking full advantage each and every time the IRS raised contribution limits. By the end of 2019, Investor 2 had accumulated 41% more than Investor 1. Let's take a look at this hypothetical graph. Investor 1, no annual increase. It's this lower line. Investor 2, annual increase maxed out every year. Quite a bit of a difference, right? So, next thing, undercutting quality. The rush to high quality funds can compromise their utility. Well, let's take a look at this. High quality funds, stocks versus low quality stocks. So high quality stocks are those that exhibit the strongest return on equity relative to their peers. And low quality stocks are those that exhibit the weakest return on equity relative to their peers. And the article describes a little bit more in more detail about these different funds. When in doubt about what kind of fund you have, just check the prospectus to confirm a fund focuses on companies with consistent earnings, healthy cash flows, manageable debt levels, and other traits associated with quality. Alright, there's something on taxing teenagers. Are kids with summer jobs on the hook for filing and paying taxes? Okay, it really depends on the type of job and how much they earn. Let's see. If they are hired as a regular employee in 2020 and their earnings are $12,400 or less, they're not required to file taxes. Their tax liability is zero federal income tax. However, Social Security and Medicare withholding may apply. Now, if they earned more than $12,400, they are required to file their tax return. Their earned income that exceeds the standard deduction multiplied by the applicable federal tax rates plus any Social Security and Medicare withholding. Now, if they're hired as an independent contractor in 2020 and their net earnings are less than $400, filing a tax return is not required. Their tax liability is zero federal income tax. If their net earnings are between $400 and $12,400, they are required to file a tax return. zero in federal income tax. However, they may owe a self-employment tax of 15.3%, and that is 12.4% for Social Security and 2.9% for Medicare. And then finally, if they are an independent contractor and earn more than $12,400, they're still required to file a tax return. Their net earned income that exceeds the standard deduction, multiplied by the applicable federal tax rates plus the self-employment tax. All right. There's something for those who are ready to retire. Wait for it. Delaying withdrawals can help extend the life of your retirement portfolio. And here again, they are splitting it up by two investors. And here they say that, again, this chart is hypothetical. Neither investor made contributions to his portfolio after 59, and withdrawals in retirement increased 2% annually for inflation after the first year. Both portfolios declined 20% in value in the first and second years and increased 4.9% annually every year thereafter. So we have investor 1 and investor 2. The portfolio of an investor who was able to wait out a market decline would have lasted 2 years longer than the portfolio of an investor who was forced to tap his savings during a downturn. Both investors start with a 1 million, but a market decline causes their portfolios to lose 20%. Boom, like that, per year at ages 60 and 61. At the same time, investor 2, this red line right here, makes 2 early withdrawals of $30,000 per year. Both investors then allow their portfolios to grow untouched until age 67, so there's that growth line, at which they take initial annual withdrawals of $50,000, which are adjusted for inflation in subsequent years. Because of 2 early withdrawals, this investor right here, investor 2, starts his 85th year with just $27,744 left in his portfolio. And that is 85, that's 83, 84, probably around here, or somewhere right here. On the other hand, still has, the investor 1 still has $100 and, let's see, $63,000, $198 left. So that's quite a difference right there. Okay. So basically, just don't make any early withdrawals if you can help it. Alright. Now this one, dear Carrie, just started a new job which offers benefits like 401k and health savings account, HSA. I want to save as much as I can for the future, but I don't earn enough to max out all my savings accounts and make ends meet. How should I prioritize? And so some of the recommendations are right here. Capture your employer match. So if the company contributes 6%, you should contribute 6% of your salary as well to max out. And if it's a dollar for dollar, your employer, that's equivalent to $100, 100% return on your contribution. Pay down high interest debt. Build up your emergency fund. Consider other tax advantaged accounts like HSA. Save even more towards your goals. So these are the recommendations. Perspectives. Pension tensions. Your company announces changes to its pension plan. Now what? And here the magazine has this article on election year markets and how to react to some of the events that have triggered our economy to go haywire. I'm not gonna go through that. Let's see what else. The White House effect. How presidential elections affect the market and vice versa. Historically, when the S&P 500 has risen in the 3 months before an election, the incumbent party generally has gone on to win the White House. When it has fallen, the incumbent party has generally lost. Interesting. Bare necessities. 4 do's and don'ts for trading in a down market. Right size your trading portfolio. So that's different from your long-term portfolio. So different from your retirement accounts. Your trading portfolio likely consists of a relatively small number of stocks, which can expose you to greater volatility when the broader market turns south. That's why this author suggests limiting the size of your trading portfolio to no more than 20% of your total investable assets. Keep trades small. So if your investable portfolio is 500,000, as an example here, the single trade should not be more than 10,000. Consider ETFs, which are basically exchange traded funds, and they have a combination of different stocks and bonds. So here the author says that it's almost inconceivable that all the stocks an ETF tracks would fall to zero. Actively manage risk. So there are certain protection tools like stop loss orders, stop limit orders, trading stop orders that could protect you. Don't jump the gun. When the market drops, it can be tempting to immediately start bargain shopping, but bargain can become the opposite if the downturn continues. When there is a big dip in the market, this author recommends waiting for 2 consecutive positive days before opening a new position, and start small. When in doubt, wait it out. Good advice here. And there's some raising the next generation of investors. Okay, some of the things when they're little introduce the value of money, emphasize saving, introduce them to investing, let them choose a few stocks to invest in, then set up regular meetings to review their performance. When they're teenagers, encourage a summer job. Introduce them to credit. Consider a Roth IRA. And when they're adults, young adults, help them set a budget. Encourage them to stay invested. Let them know they're not alone. This is pretty good as well. I like these articles so far. You know, I never read this magazine, but it's pretty good. Now, let's talk about rebalancing your portfolio. Imagine an investor with a 500,000 portfolio and a target allocation of 60% stocks, 35% bonds, and 5% cash investments. After a rough few months, the stock portion of his portfolio falls by $75,000. That's where he started, and this is market correction, $425,000. At the same time, the investor needs to withdraw $15,000 from his investment portfolio to cover an unexpected bill. To figure out what to sell in order to meet his cash need, the investor should: number 1, subtract his cash need from his current portfolio balance. So that $245,000 minus $15,000 to equal $410,000 new portfolio balance. Number 2, use this portfolio balance in target allocation percentages to determine his target dollar amount for stocks, bonds, and cash investments. So to achieve his target asset allocation, the hypothetical investor actually needs to buy more stocks, presumably at lower prices, which should work in his favor should the market turn around. After selling his overweight positions and buying underweight ones, the investor can use the remaining cash proceeds to pay his unexpected bill. So that's his balance, $410,000. Target allocation, 60, 35, and 5. Target amount minus current amount, and that's the number that's needed to reach the target amount to get those cash proceeds. It's quite complicated if you look at it, but if you stare at it for a little while, you'll figure it out. These stock markets could really need some studying sometimes. Some of that is intuitive and other does require some studying and understanding of the terms. choosing the right allocation for you. So if you want to withdraw within 3 to 5 years, 5 years, 10 years, and 15 or more years. So that's based on that. You can decide how you want what's your ultimate strategy. So if I want to withdraw in a short period of time, conservative is the right way to go, where these are the allocations: cash 30%, stocks are only 20%, and fixed income 50%. So plan kind of for that. Stop thief. Alright, that's an unauthorized withdrawals. Act fast, go wide, stay alert, double up. I can tell you that from my experience, my credit cards have been used in the past to purchase different things. Just recently, I have noticed 2 charges from a gas station that did not belong to me, and I immediately contacted my bank and got it cleared out. But pay attention, I do it at least a few times a week. A little bit of ad, more ad. I think that is it. Yeah. I hope this was interesting, relaxing. I know finance cannot always be relaxing, but we can really educate ourselves and prepare for the future, especially in these times of uneasiness, or somewhat of uneasiness. There gives us knowledge, gives us power, gives us somewhat of a control over what we do. In the meantime, I encourage you to take care of yourself and be kind to one another, regardless who you are, what your background is. Take care of yourself. Goodbye.